What up, HyperChange? Welcome to another episode. Today we're talking about what probably used to be your favorite burrito chain, Chipotle. Chipotle stock has hit a 4-year low on the back of even more food safety concerns. As a whole, the stock has been in a decline for the past 2 years after an E. coli outbreak in late 2015, and I actually think the valuation is starting to get interesting. The market cap is now below $10 billion, despite the fact that it looks like they're going to be able to cross $5 billion in sales in 2018. The price sales multiple is compressed to the cheapest we've ever seen in the last 6 years. This is a solid business. They're on the road to recovery. I think Chipotle is worth a second look. Let's break down what happened. In late 2015, some food health outbreaks occur, the stock starts getting hit, people start freaking out, and it was justifiably so. Customers weren't returning. Sales for all of 2016 were a debacle. As you can see by this chart, Chipotle was on a tear. They were super profitable. They were growing revenue and earnings every single year. And then all of a sudden in 2016, they had a dud. They barely made any money. Their sales were down big. Customers were fleeing stores. Management had to rework. A lot of what was going on, like a very difficult time. But now, during the first half of this year, they've actually finally been able to recover. Revenue was up 22% in the first half of this year relative to the first half of 2016, and they're showing that they can make a profit again. In the first half of 2016, they were losing, their operating margins were negative 0.3%. In the first half of this year, they're positive 8%. So the company is back on track, they're growing, they're making money again. I think this is all good. But now the question is, how profitable will they be able to come? 8% operating margin is great, but it's nowhere near the 17% they were doing before this food safety outbreak hit. Now, if you'll take a look at this chart, Chipotle was able to sustain 16 or 17% operating margins for years as they were growing very quickly because they were simply executing on fire. Stores were packed, people loved going there, they were run incredibly efficiently, and that was leading to one of the industry's best operating margins. But do I think they'll ever be able to recover to that level? I mean, if they can, the stock is a home run, but I really don't think they'll be able to, simply because they've overexpanded. There's a lot more Chipotles out there. I think the brand had a little bit of permanent damage done with that food safety outbreak. I also think there's a lot of competition in the fast casual Mexican space that has been heating up. For instance, around me, there's a place called Taqueria Diana, which sells burritos for the same price as Chipotle, but are like twice as good. So I don't know if that's happening in the rest of the country, but interesting to know. But my point is, I don't think operating margins ever have to recover to 17% for the stock to still be very attractive at $340 per share. Hear me out. Let's assume they get 9% operating margins this year. On the analyst consensus, $4.54 billion in revenue. That's about $400 million in earnings. Given the market cap is about $9.7 billion, we're looking at a 24x price operating income ratio based on this year's earnings, which is a little bit expensive, but I don't think we're seeing the true normalized earnings power of Chipotle because I still think there's some effects, kind of like a hangover from that food safety issue. So if we assume that they continue to improve operating margins next year to a level of 12% and are able to grow sales another 10%, this is based on new store openings and still recovering traffic at the stores that are open, then it looks like they have the potential to do $600 million in operating income in 2018. Based on the current market cap, that's only 16 times forward price operating income, which is a very fair price to pay for this business, in my opinion. And that's kind of assuming a very moderate recovery, that they'll never be able to get back to that 17% level. I mean, if you look at this chart, I'm trying to be conservative here because I really think Chipotle's best days on a per restaurant level basis are behind them. That being said, Chipotle has 25% more stores open today than it did 2 years ago. Therefore, they never need to return to the same level of per store profitability to make the same profits as a company. If you think about it like that, Chipotle was able to do $780 million in earnings in 2015. And that was with 25% less stores, So if they ever do return to that store level profitability, we're looking at a business that could easily do well over $1 billion in earnings. And for a company that's trading less than $10 billion, that's a less than 10 times earnings ratio. So there's a lot of upside to get excited about here if they can really start firing on all cylinders. But even so, I don't think that needs to happen. At $340 per share, the stock has just been hammered because of this. I think it makes a lot of sense if you believe in the recovery that shares are fairly valued and they have a lot of upside. Additionally, While all this has been going on, management has been very smart about buying back stock. They've reduced the share count from about 32 million 2 years ago to now 28.5 million. They still have a buyback in place. And my guess is if the business keeps producing cash the way it is now and shares stay around 340, 350, management's going to keep buying stock, and that's going to build even more value long-term for shareholders. So I really like what they're doing there. Additionally, like, they have 500 million in cash, no debt. Like, this is a rock solid business. They're not going to go bankrupt tomorrow. Here's my X factor pitch. All that being said, I think there's even more optionality, and the only way I think Chipotle could ever return to that 17% operating margin is if they launch the breakfast burrito. Hear me out. They're already paying rent. They already have all these stores. Instead of opening it up at 11 a.m., they can open it up at 7 a.m., hire employees to get there early. The only ingredient they need to add for the breakfast burrito is eggs. Maybe get some coffee. You could sell that at a really high margin. And then I think we have a business that could potentially return to 17% operating margins because of that incremental breakfast possibility. Now, Chipotle has tried out the breakfast burrito at the Dulles International Airport in 2015. The Yelp reviews were pretty good, but management didn't seem to think that it was worth it, and so they canned it. But I still think they're going to be trialing this, and if I was the management team, I would figure out a way to do breakfast, because you already have all these stores. If they can get people coming in for not just lunch and not just dinner, but breakfast as well, that's going to transform the business model and give them a shot at returning to 17% operating margins. Now, if they can do that, then things get really exciting. If the company can do 17% operating margins on its $5 billion in revenue in 2018, then we'd be looking at $850 million in operating earnings, only a 12 times forward PE ratio. So if you assume the company can get back to the margin levels that they were doing pre-food health crisis, I think the company's looking really, really, really cheap. So anyway, to wrap it up, the market seems super bearish on Chipotle. I don't know why, because I think the recovery is going well. I think this is a solid business, solid management team, and if they can figure out what they're doing with breakfast, you have got a lot of upside here. So go try out a burrito, see if they're still good. Hopefully you don't get sick. Let me know what you think. If you have another stock that you want me to do, this is a request. So if you have a request of a company you want to make an episode on, let me know. I'll do it. That's HyperChange. Subscribe if you haven't already.